It doesn't take away any of your options. In fact, you're able to scale and grow. And they were able to buy 2 assets now, one from policy loan, one from bank HELOC, while all their cash was still growing in the policy, uninterrupted. Imagine the potential in just that. And this is the unseen on IBC. I call this a tale of JV partners. So Philip and Manish were 2 JV partners. Philip is an engineer. He's age 38. They both married. So Philip's wife, she's 39 years young. His daughter is age 3. Manish is a project manager. They happen to actually work at the same company. That's how they know each other. Manish is age 39. His wife is age 36. But Manish has a daughter and a son. So just a little intro on the 2 of them. They've been investing in real estate since 2012. Most of their properties are joint venture, and it's always between the 2 of them. They have really good income, so they are able to produce income, set aside money, and really buy a lot of properties. The good thing about them, as they went through their own education coaching program, and then when they met, they were coachable, they were teachable, they wanted to learn more. They weren't suffering with something, as Nelson calls it in his book, called arrival syndrome. And arrival syndrome basically describes an individual who is completely arrived in knowledge, and they know everything that there is to know in world. You may actually be knowing someone today who's suffering with stage 4 arrival syndrome, but Manish and Philip, they didn't suffer with that. They were coachable. Now, they discovered IBC in 2016. And again, we want to power education. Education is key. Investing in yourself to learn anything worth considering. Yes, it's important. No different than how you may have invested your time and energy to learn about real estate investments. It doesn't happen overnight, right? You need a coach, you need education. Now, 2016 meeting facts. So they had no life insurance because as investors, and me including, when I got started with my own properties, I never focused on this. I just focused on building wealth through real estate. So the focus wasn't life insurance because nobody told me about it. Nobody told me the importance of protecting and the issues that we'll create once we're gone. I don't know about you, but I don't have a lease on life. We all have our best before dates. We just don't know what that date is. Financial planning will be so much easier when we know what our graduation date is, which is a best before date, and then we just work backwards to solve for the problem. But the unknown is we don't know when our best before date is. We know that at some point in time to come, we're all going to be angels, and we need to solve for that, because the last thing we want to do is leave the family behind in more financial issues. So total debt. So they had borrowed money from the bank, about $1 million, to invest into properties. These properties are personally owned. Now, Philip's annual income is $120K. Manish is $130K. So great income between the 2 of them. The passive cash flow from the investment portfolio that they have created so far is about $20,000 per year, which is very, very good. Their ultimate investment goal, so they use some strategies. They flip, they do buy and hold, and they do borrow strategy also. But ultimately, they want to have enough money coming out of their assets. They want to build their assets to a point where they can quit the 9 to 5 and work for their assets rather than trading their time. We all want to do that. That's one thing that we all want to achieve, is financial freedom. Now, here is how the IBC journey started. So first thing, with the family protection. Now, they both own $1 million of debt. So bank lend them both money. So if one is gone, they still owe $1 million to the bank, and the other person can struggle with that, and bank may call the loan. We don't know. There's so much unknown. So immediately we started protecting their assets that they've worked so hard to create for the family. So the first thing that we did is we did a joint venture policy. So basically, Philip is going to own a policy on Manish for $1 million because they have $1 million in debt, and Manish is going to own a policy in Philip for $1 million. And when we structure that just based on 10-year term insurance, because the term insurance premiums are low, and then they may want to keep the relationship together working on investments for 10 years, and after that they may not. So this term insurance for now meets the need. It's very inexpensive. You can see Philip owning a policy. The premium is $416 a year, so it's pennies on dollars. God forbid something happens to Philip. Manish owns a policy on Philip. The premium is a little bit less because Philip is in a little bit better health than Manish. Now, they've named each other as beneficiaries. So God forbid something happens to Philip, Manish gets the death benefit. Manish will use that death benefit to pay Philip's wife and keep the properties. And then Manish can have that from passive income standpoint and grow it furthermore. And then same thing with Manish. If something happens to Philip, Manish gets death benefit. Manish will use that death benefit, a portion of that, to pay Philip's wife out, and the remaining can go to the bank to pay off some indebtedness that they have. So this is just to protect the interim, God forbid something happens prematurely. We create this crisscross arrangement on mostly all joint ventures that we work with. So again, we talked about this. If Philip graduates, $1 million is paid to Manish, and then Manish will use that to buy Philip's share from his wife and vice versa. Now, banking system, this is the main reason why they met with us, is to create their banking system, because they wanted to finance more properties from their system versus relying on banks. And they understood that policies will keep on growing, and it's not just going to be used today to finance properties, but the policies can also be used for passive income time in future. So they started policies in 2016. And again, this premium just so happened to be the same premium for Rich. But what they're doing is 25,000 of that premium is what Manish is paying into policy, and 25,000 of the premium is what Philip is putting into policy. So combined together, that's $50,000. Now, it doesn't matter what the premium is. Premium is what you want it to be. Premium is based on where we are in a life journey. You know, when I first got started in this process, my premium wasn't what you see on the screen. My first policy was only $5,000 per year. My second policy was $2,400 per year. Over the course of time, I've added 16 policies, and each policy has different premium. But this is something I created over a course of almost 6 years. But I started where I could. Being a real estate investor, when I got started in this journey, I was asset rich and cash poor. So I started where I could. Now I put a good chunk of money into it, but I didn't start there. We start where we can, and starting is more important than not being able to start at all. When you have a readily available pool of capital or access to capital, opportunities will come find you. And Nelson has said this, and he is so absolutely correct. We are seeing opportunities everywhere. Our people who practice infinite banking, they're seeing opportunities. If you have access to cash today, you are seeing those opportunities already. So Feb 2022, so this year, they are flipping a house, a condo in Edmonton. So the property purchase price is $160,000 in Edmonton. Now the renovation work required on this property, so it needs a little bit of reno. The amount of work required will be about $20,000. So what they need is about $180,000 of capital from their banking policy to make this happen. Now, so they need $180,000 plus small closing costs on the property. Now, estimated fair market value. So once the renovation is done, they can sell the property between $215,000 and $230,000 quite easily, provided they find the perfect buyer. Now, when someone is flipping, and if you have flip properties, you may already be familiar with it. Once we're ready to flip the property, it may not flip at that time. We may have to hold the property for a few weeks or even a few months to find the perfect deal. But this is what they're estimating based on the underwriting that they've done on the property. Now, total cash value. So they started policies few years ago. So the total cash values in the policies as of today is about $300,000. Now, policy loans, so today they can access about $281,000, which is the 90% of the cash value. Now, since then, they've actually added a few more policies also. It's not just these policies that they have. Now, policy loan amount today is $281,000, which is the 90% of the cash value. Now, capital required to make this flip project happen is $180,000, so $160,000 to buy the property and $20,000 for the renovation. So you can see there's more than enough money in the policies now to request a policy loan for $180,000 and continue with the project. They don't have to rely on anybody else's financing. They're just doing it from the policies. So this is where Nelson says in his golden rule, think long range, which is his first golden rule, don't be afraid to capitalize. They understood the problem and they weren't afraid to capitalize. And this is what is creating for them in a matter of 6 or 7 years of starting a policy. And everybody can do that, right? Now, daily cash value growth. So as of today, this is their daily cash value growth, $54 per day. Again, how do I know that number? I look at the numbers today. I look at the numbers very next day. The difference is $54 per day. And that's just for this year. Next year will be better than that. Year after that, it'll be better than that. So $54 per day, that's $1,620 per month in terms of monthly growth, contractually guaranteed, because cash values and death benefit must match by age 100 in a participating whole life policy. The policy loan, so they're initiating $180,000. Now, when we initiate a loan amount of $180K, about $50K of that can show up as EFT, which is electronic fund transfer. Anything above 50K, insurance company will have to send you a check. Now, as of today, so if you remember the car example that I went over, the interest from insurance company at that time was 7% simple interest annualized over the year. As of today, for the same company, the interest rate has gone down to 6.2%. Now, daily interest, so when you initiate this loan on a simple interest, it's charged on daily basis. So 180,000 multiplied by 6.2% divided by 365. This is the formula. You can see this is their daily interest on the loan. Now, as compared to the daily growth in the loan, they're making way progress, $54 per day in growth, and interest is $30. They are able to recapture the interest to the insurance company in the growth of their policy. So this is the daily interest multiplied by 1 month. It's multiplied by 30 days. That's $917 a month charged by the insurance company on the loan. But this daily growth, monthly growth, is not interrupted. Now, using the policy loan, they own the condo free and clear because the policy loan doesn't show up on TransUnion and Equifax. Their cash values was used as collateral. The lien is the death benefit, not what they're going to use the money to buy. So technically, they own the condo free and clear using insurance company's money, while their money is still growing in the policy every single day uninterrupted. Their compounding of their wealth hasn't stopped in the policy while they're still able to go and buy the condo. So they're creating dual compounding in a way. They control 100% of repayment terms on the loan, principal and interest. They chose just to service the interest only for now. So the interest per month was just about $900. Now, here are the options after renovation is complete. They can flip the property if they find a perfect tenant. So they can flip it between $215 and $230. That was the price range. And then once the property is flipped, they take that money and backfill the policy loan principal and interest. The remaining is profit. And once the policy loan is backfilled, they can go back and reaccess that money and plus the growth and go buy another flip property if they wanted to. Now, they can also use it for short-term rentals in case they don't find the perfect buyer for their property. They may delay flipping it. It's all based on what the market is going to do because the whole project may take anywhere between a month to 2 months to get the condo ready. What if they're not able to flip it? Let's analyze the short-term rental on this property now. So let's assume that they couldn't flip it. They're going to do a short-term rental. And let's analyze the short-term rental transaction on this property. So remember, they own the condo free and clear, and they need to service the interest only to the insurance company because that is all that they want to do. So they rent out the condo. The condo is rented for $1,600 per month. The condo fee and property tax approximately is $300 per month. The interest payment to insurance company every month is $917. So $1,600 comes from rent. So $1,600 minus $300 minus $917. So their net cash flow positive of $383 a month. It's difficult to be cash flow positive in a condo market. I'm not sure which city are you joining in from, but I'm in Edmonton, and unless you get multiple families or you do short-term rentals or you do Airbnb, it becomes difficult to own cash flow from a condo. So in their case, just because the debt is structured very differently, it's just interest only, and they chose to pay interest only to the insurance company, they have this positive cash flow, about $383 a month, which is still a great thing. So as they find the right buyer for this property, they're still cash flow positive, and all their cash in the policy is still growing at the same time. So cash value growth is $1,620 per month. Total increase in monthly net worth, $1,620 in the policy plus $383 from this cash flow. So per month, the net worth is increasing by $2,000. And I'm not even considering any appreciation in the condo. It's just from the transaction and becoming a banker. That is what they're able to achieve. Now, for $1,600 a month, this is what they are receiving as a rent payment from this tenant. The net worth increases by $2,000, not including the condo appreciation. So when you are receiving $1,600 a month from your tenant, how much is your net worth increasing every month by? And I'm not talking about property net worth, I'm talking about liquid net worth. This money is all liquid. They can access this money at any time if they wanted to. Condo is in addition to it. So there's an opportunity to recycle more money if they wanted to. Now, I talked about the unseen. So here's the unseen, which is also happening simultaneously as what I just described, in addition to what I just described. See, because they own the condo free and clear, and the reason why they were able to do that is because policy loan doesn't show up on TransUnion or Equifax. They can actually go to the bank and register a HELOC on the property. You'll be surprised. You already know this. Banks love to collateralize a property. Now, there's no indebtedness in the property because the lien is death benefit. They can go to the bank. They've appreciated it to the fair market value. They bought it at 180. The fair market value is 230. They can actually go to the bank and register a HELOC on the property because they kept the loan private. Can they use the HELOC from the bank to perhaps buy another property if they have another opportunity showed up? The answer is yes. So if they sell the condo, can they use the condo to pay back policy loans immediately without penalty? The answer is yes. Can they re-access the policy loans to buy the next investment? The answer is yes. So imagine this, guys. They took a policy loan, they bought a condo, they fixed up the condo, they have a tenant in there, it's producing cash flow, the appreciation has gone up. And because it was a policy loan, there's no indebtedness in the property, they could actually register a HELOC. So they haven't lost access to potential growth in real estate investment at all. Now they can take banks' money and maybe buy another property because if there's an opportunity out there to buy, well, great, you need access to capital. By doing it this way, they haven't lost access to capital. And then going forward, they can actually use policy loans again to pay off the HELOC, and they can rinse and repeat this whole process again. So by keeping loans private, it doesn't take away any of your options. In fact, you're able to scale and grow. And they were able to buy two assets now, one from policy loan, one from bank HELOC, while all their cash was still growing in the policy, uninterrupted. Imagine the potential in just that. And this is the unseen on IBC. So if you want to scale your investments, this is the best way to do it. One of the best ways to do it and have the full control on your banking function. And in addition to that, God forbid, if they died, they have boatload of death benefit to pay everything off, outstanding policy loans, HELOC, and keep these properties in the family and still leave behind additional tax or death benefit to the family. If they live a long life, they're going to do just fine. God forbid they become an angel prematurely, the family is going to do just fine. You win, you live, you die, you still win. So using the process of becoming a banker, they're now able to own two properties, two cash flow. They have tax deductions on interest payments while their money was still compounding tax-free inside the policy. In addition to that, the properties were also appreciating. Now, again, we talked about if the unlikely happens, that occurs, they don't leave any indebtedness behind to either of their JV partners, so to themselves or to their family, and they can use policy in future for retirement because while they were doing all this, the policies kept growing and it's going to produce tax-free passive income based on the examples that I shared earlier on using policies for retirement. Is going to produce tax-free passive income in future. And if they have real estate in future, which is going to produce taxable income for them, policy loans or loans against the policy is not going to put them in the bigger tax bracket.